We talked earlier about capital, capital inside the U.S. versus capital requirements outside. When you form an insurance company, you're not going to get a license unless the company is going to have some money in it. And when you think about it, it makes sense. It's an insurance company. It's a startup. It's basically without any capital. Its only revenue is going to be the premium it takes in. And what the insurance commissioner is looking for is, do you have some ability to pay claims if they come other than with premium dollars? So there's going to be a requirement. There are two types of requirements. There are judicial requirements, jurisdictional requirements. In other words, every state or country has a specific requirement that's just statutory. They require, this is your minimum capitalization. If you don't put this up, you won't get a license. So you can, a couple of examples here. Cayman requires 125,000, Anguilla requires 100,000, Nevis requires 27,000, Vermont is 200, and Nevada are both 250,000 or more. And so there you're starting to get a sense of what the differences are between U.S.-based and non-U.S.-based captives. But that's sort of not really the end of the discussion, because there's also, in addition to the statutory requirement, there's also a reasonableness and a premium-based requirement. So from a reasonableness point of view, you're always saying to yourself, gee, is $27,000 really enough capital to have an insurance company startup that's got the potential for $1 million or $2 million in claims? And you know, if you're a thinking person, the answer is going to be, that's not enough. I mean, that's laughable. So even though in Nevis, if you start up, theoretically, the capital requirement is $27,000, in real life it's going to be more like $100,000 or $200,000, depending on how much risk you're taking on in your captive. And the way the insurance commissioner knows is because you tell them. Your captive manager has to, as part of the license process, has to essentially submit a budget. Here's what we think we're going to write in terms of risk this year. Here's what our annual premium is. Here's what our capitalization is. Here's what we think our profitability is going to be. Here's what we think our claims experience is going to be. And the insurance commissioner is going to look at that, and they're going to say, okay, then we think your capitalization is reasonable or it's not. And if it's not, they're going to tell you what they think is reasonable, and then you're going to make a decision. Should we stay in this jurisdiction? Should we move? Should we stay and fund the capital as required, or whatever? So that's number one. Number two, capital is partly a function of premium. So if you don't have significant capital, you're not going to be able to write significant risk. And if you don't write significant risk, you're not going to be able to have significant premium. So they're tied in that way too. So just from an actuarial point of view, you're not going to have enough money, or if you don't have enough money, you're not going to be able to write substantial risk, and therefore your premium may not be where you want it to be. So what do I mean by that? Well, if somebody wants to write $500,000 of premium in their captive, or $1 million of premium in their captive, the capitalization requirement is going to be different. It's obviously going to be higher for $1 million of risk. So again, you not only have to have free cash for your premium, but you have to have free cash lying around for capitalization.